Welcome to Trading Nation. I'm Mike Santoli. Earnings season officially kicking off this week. Even if the numbers do exceed expectations, though, our next guest believes uncertainty will likely prevent a sustainable rally for now. Art Hogan joins us first on CNBC since starting his new job at National Securities as Chief Market Strategist. Welcome, Art. Good to see you here.
Hey, good to be here. Thanks so much for having me.
Congrats. In an interesting market juncture here for you to kind of have a fresh start as well, right? Market up 10%, still down double digits from its highs.
Yeah.
And we have this sort of lingering question of where we are in the cycle. So how do you see it playing out?
Yeah, I think you framed it perfectly. So when you think about coming into an earnings season, where are we at valuations? And you know, being 10% off the highs and 10% off the lows hits us about 15 times in the S&P 500. So probably pretty neutral. That's the good news. The bad news is that the uncertainty outweighs the fundamentals. So even when you get some good reports, I don't think we're going to get many from the financials, but when you get good reports, it's hard to react and it's hard to conceive of any guidance that's going to be upbeat for 19 unless and until we get some things behind us. Not the least of which is trade war with China, certainly a Mueller investigation, you know, some answer on Brexit, but there's an awful lot of things that we don't know that until we have some answers, it's going to be difficult to get some traction here.
So I guess the base case is that there's not that much incentive or ability of companies to tell a bright story for earnings in the next few quarters. So where do you think earnings will settle, earnings growth will settle for this year?
Right, it's interesting. So they've come in incredibly fast, right? So the month of December woke everybody up to the fact that, A, the global economy is slowing down a bit, so everybody had to reset their expectations for 19. I think estimates for the S&P 500 are probably at or where we can achieve if in fact we answer some of these unknowns. I think some of the global economic slowdown is being caused by the uncertainty over trade, right? So if we were to get some answers on trade, let's say in the first quarter of this year, we may be undershooting in terms of our estimates. The difficult part though, Michael, as you know, is the S&P 500, about 45% of the S&P 500 stocks do more than half their revenues from overseas.
Yeah.
If we have a slowing global economy, you're going to see that affect the earnings growth and the earnings power of the S&P 500. I think that's where we get concerns. I think that's why we had to take our targets down heading into 19. It's that concern over economic growth and how quickly we get some answers on things like trade, things like Brexit, the important fundamental things.
Now talk about your target for the S&P 500 and what it is going to take. What are the assumptions that go into it?
$175 and
this is 28.50 you said.
Yeah, 28.50, so 175 and 17 and a half times. So we ratcheted down by about $5. You know, our estimates for the earnings growth on a top-down basis for the S&P 500. The multiple we kept the same at 17 and a half. So we think 12 months out, that's reasonable. We're trading about 15 times that estimate right now. So you're talking about 2 multiple turns, 2.5 multiple turns. None of that happens in a linear fashion, though. There's going to be a lot of bumps in the road along the way, and certainly we know, you know, we've seen some of that already. But I think that that's justifiable if we don't have things extend. If the government stays shut for much longer, if we drag out this trade war for the entirety of the year, those earnings numbers are going to come down, and so will the multiple.
So if we're going to be expanding back up to a 17-plus multiple, and earnings are going to have decent growth, 175 would be, you know, relatively decent growth. It would seem as if the market's not going to be handicapping an immediate recession by the end of this year.
Right. And I don't think that's what the market is doing, right? I think that, you know, talk of a recession necessarily is not 2019's business, but talk of the amount of a slowdown that we could possibly see. We could see an earnings recession, right? You could see earnings growth that are flat or modestly negative, right? And I think that would make sense in the backdrop of ongoing concerns over trade, ongoing concerns over Brexit. If we continue to see Italy and Brussels fighting over their budget, all those types of things that are in the mix right now that we don't have answers for. Yeah. I think we get some of the answers to those questions. I think we can actually have a bit of a plateau in the concern over a slowdown in global economic growth, and we may be able to do, you know, a decent 5 to 6% earnings growth for the S&P 500 a normal year.
And some of these bumps in the near term, you figure we have to revisit the recent lows or not?
Probably. I think that it's hard to know where that's going to come from. You know, typically we know, okay, we get to the March deadline and let's say the administration decides to say, okay, we're going to 25%. That would certainly cause us to revisit the lows. Or if some bombshell or another bombshell or another shoe dropped in the investigation and the House really agitated for an impeachment process, and it's hard to sort of, you know, paint a map for that. It's hard to, you know, diagram that out. So I think it's certainly, the flip side of that is we're at a valuation where it wouldn't take very much good news to have the other kind of volatility. And we've seen that as well.
All right, and we'll talk about the Fed another time. Thanks, Art. Appreciate your time today.
Thank you.
Art Hogan. And thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.